Chapter 3, the adjusting process. There are two approaches to accounting for entities. A cash basis approach focuses on actual cash collections and payments. Revenues are recorded when cash is collected, and expenses are recorded when cash payments are made. An accrual basis, on the other hand, recognizes that the recognition of revenues and expenses should not be affected by the timing of cash collections and disbursements. Rather, revenues and expenses should be recognized when the underlying economic activities actually take place. So, for example, revenue is recorded when it is earned, even if the collection of the cash takes place at a later date. Accrual basis accounting is required by generally accepted accounting principles. Cash basis accounting is not allowed under GAAP. The time period concept simply states that it is appropriate to report a company's information periodically at predefined time intervals. Usually those time intervals are months, quarters, or years. Typically, a company's fiscal year spans a period of 12 months. However, not all companies begin their fiscal year on January 1st or end it on December 31st. Many companies begin their fiscal year at the beginning of a quarter following a slow period. For example, an agricultural-based company may begin its fiscal year on April 1st and end its fiscal year the following March 31st. The revenue recognition principle defines both the timing of the recognition of revenues as well as the amount of revenues that must be recorded. First, revenue must be recognized at the point in time when they are earned. The earnings process is deemed complete when the seller has either delivered a product or performed a service. In business, it is typical for a customer to wait 30 or more days to pay for products or services. However, under GAAP, the collection process is looked at as a separate process from the earnings process. So, when revenue is earned, it is recorded at that date, regardless of the timing of the collection of that revenue. Second, the revenue recognition principle tells us that revenue must be recorded based on the actual sales price. So, for example, if we normally sell an item for $200, but it is currently on sale for $100, then when it is actually sold for $100, the amount of revenue recorded will be $100. The original $200 sales price becomes irrelevant. The relevant amount of revenue is the agreed upon price at the time of the sale. The matching principle states that expenses that are incurred should be matched against the revenues that they are related to. Because contracts for services can cover long periods of time that extend past the end of a fiscal period, or the purchase of goods for resale are often purchased in advance of actually being sold, the matching of expenses and revenues does not necessarily occur naturally. The adjusting process can be used to force the recognition of expenses into the same period as the related revenues. The trial balance that was generated in Chapter 2 is generally referred to as an unadjusted trial balance. This trial balance shows the raw accounting data before any attempts at matching of revenues and expenses. After we apply the time period concept, the revenue recognition principle, and the matching principle, we often find that adjustments to the raw trial balance are needed. Let's look at an example. The unadjusted trial balance for Smart Touch Learning shows a balance in office supplies of $500. This represents the amount of office supplies that were purchased earlier in the period. However, it is logical to assume that some, if not all of those office supplies, have been used during the period. If we count the office supplies on hand and discover that the current amount of office supplies on hand is less than what we purchased, that would indicate that in fact we used some of the office supplies. This would mean that the current office supplies balance of $500 is no longer a fair representation of the amount of the office supplies that Smart Touch Learning currently holds. It would become necessary to adjust the account to reflect the amount of office supplies that have been used during the period. The adjustment would be effected by using an adjusting journal entry. These are typically referred to as AJEs. Mechanically, an AJE works just like any other transaction-based journal entry. The accounts to be adjusted are identified. A determination is made as to whether to debit or credit each account. The adjusting journal entry is entered into the system and then it is posted to the general ledger. There are a couple of distinguishing features for AJEs. The most notable is that AJEs are usually made at the end of an accounting period. In our office supplies example discussed earlier, we would reduce the office supplies account by the amount of the office supplies that we had used. We would concurrently record a debit to office supplies expense to indicate that those office supplies had been used in the process of generating revenues. There are two basic types of adjusting journal entries, prepaids and accruals. There are two types of prepaids, prepaid expenses and unearned revenues. Each of these represents either a prior expenditure related to a resource that will be used in the revenue-generating process, or an advance receipt of cash from a customer that obligates us to either deliver a product or perform a service for a customer in the future. Our earlier example of office supplies is an example of a prepaid expense adjustment. Accruals require experience and business intuition to recognize that even without the pre-flow of cash, the company might earn the right to receive cash or incur the obligation to pay for an expense as a result of something done by a third party. In transaction number 10, Smart Touch Learning prepaid 3 months of the lease on its building, paying $3,000 or $1,000 for each month. The initial entry required a debit to the prepaid rent current asset account and a credit to cash for $3,000. This represents that Smart Touch Learning has the right to use the property for the next 3 months. By the end of December, Smart Touch Learning has used 1/3 of its right to use the property. The account prepaid rent still indicates that they have the right to use the property for 3 months, even though one of those months has been used. The account needs to be adjusted so that it communicates the correct information. To do this, we will need to prepare and post an adjusting journal entry to the prepaid rent account. The adjustment will require that the prepaid rent account be reduced by 1/3, while $1,000, 1/3 times $3,000, be entered into the rent expense account. The entry will require a debit to rent expense and a credit to prepaid rent. Most prepaid adjusting journal entries are related to the adjustment of a current asset account. However, long-lived tangible assets are also used by the company to generate revenues. They act much like other prepaid assets, except for their longer life. At the end of each fiscal period, it is necessary to adjust the long-lived tangible asset accounts to account for the consumption of their usefulness. This process is called depreciation and is an important prepaid adjustment each period. Depreciation is usually defined as the periodic, systematic allocation of the cost of a long-lived tangible asset to expense over its estimated useful life. The more common prepaid adjustment debits an expense account and credits the prepaid asset account. When recording depreciation, a debit is also made to an expense account called depreciation expense. The credit, however, is not recorded in the asset account. Rather, it is recorded in a contra asset account called accumulated depreciation. The accumulated depreciation account carries a credit balance, appears in the assets section of the balance sheet, and is matched or netted against its related long-lived tangible asset account. One notable exception to this process is land. Under GAAP principles, we never depreciate land. Assume that on December 2nd, Smart Touch Learning received a contribution of furniture having a market value of $18,000 from Sheena Bright. The original entry will include a debit to the furniture account on the balance sheet and a credit to the Bright Capital account. Also, assume that the furniture has a 5-year useful life. For this example, we will use the straight line method of computing depreciation. Using this method, the cost of the asset after adjusting for residual value is allocated evenly over the estimated useful life of the asset. In this case, we will divide the $18,000 cost of the furniture by the estimated useful life of 5 years to arrive at an annual depreciation expense of $3,600 per year. In this case, the asset was only owned during the last month of the fiscal period, so the depreciation must be further allocated by dividing the annual depreciation amount of $3,600 by 12 months to arrive at a monthly depreciation amount of $300 for the month of December. The entry will require a debit to depreciation expense furniture of $300 and a credit to accumulated depreciation furniture of $300. Unearned revenues arrive when the company receives payment in advance from a customer prior to services being performed or products being delivered. The acceptance of the payment creates an obligation on the part of the company to either deliver the product, perform the service, or return the money. It is a liability. The liability is recorded when the payment is received and then must be adjusted at the end of the period to recognize the portion of the payment that has subsequently been earned. In our example, Smart Touch Learning initially recorded a liability of $600 for unearned service revenue. Between the time the payment was received and the end of the month of December, Smart Touch Learning performed 1/3 of the services required, which means they have earned 1/3 of the revenue. To recognize this, the unearned revenue account is adjusted by debiting or reducing the unearned revenue account by $200 and crediting or increasing the service revenue account by $200. Accruals are a little harder to identify, though the actual adjustment may be a little bit simpler. In the case of an accrued expense, we will always debit an expense account and credit a liability account as part of the adjusting entry. Assume that Smart Touch Learning normally pays its employee a monthly salary of $2,400. Smart Touch Learning typically pays half the salary on the 15th of the month and the remainder on the first day of the next month. If we look at a calendar for December 2014, we see that December 31st, 2014 falls on a Wednesday. On December 31st, Smart Touch Learning will need to recognize that they owe their employee for 1/2 month of salary, or $1,200. To record the entry, Smart Touch Learning will debit salaries expense for $1,200 and credit salaries payable for $1,200. When the payment is made on January 1st, the salary payable will be debited, effectively eliminating the liability, and cash will be credited. Accrued revenue occurs when the company earns revenue, usually as a result of performing services or as a result of passive earnings process, such as earning interest or dividends. The revenue needs to be recorded, but the cash has not yet been received, or in some cases has not even yet been billed. The entry always requires a debit to a receivables account and a credit to a revenue account. Assume that on December 15th, Smart Touch Learning agrees to perform e-learning services for $1,600 per month. Over the next 2 weeks, the second half of December, Smart Touch Learning performs 1/2 month of services. They have earned 1/2 month of revenue, but they have not yet collected it. The entry will require a debit to accounts receivable for $800 and a credit to service revenue for $800. The adjusted trial balance differs from the unadjusted trial balance in obvious ways. Primarily, after the adjusting journal entries have been journalized and then posted to the general ledger, a new list of the accounts and their balances is necessary. This new adjusted trial balance will include the original accounts from the unadjusted trial balance, as well as some accounts that were created by the adjusting process itself. The adjusted trial balance includes accounts that did not appear on the original adjusted trial balance, as can be seen here. The financial statements are prepared directly from the adjusted trial balance. The adjusting journal entries are absolutely necessary to the financial accounting and reporting process. Without them, many accounts would be understated and others would be overstated. For example, if we fail to record accrued revenues, both the assets and the revenues, and subsequently the net income, will be understated. A worksheet is a convenient, visible way to illustrate the adjusting process. Although it is not a substitute for the journal and ledger, it nevertheless is a very useful tool for determining what the final balances will look like. The first step is to enter the information from the unadjusted trial balance into the unadjusted trial balance columns on the worksheet. Second, we enter the amounts from each of the adjusting journal entries. Note that we can foot the columns to make sure we have properly entered all the necessary information. Finally, we cross-foot the numbers to the adjusted trial balance columns at the far right of the worksheet. Remember, foot or to foot a column or cross-foot a column basically just means to total it up. The nature of most prepaid expenses is that they have very short lives. Rather than set them up initially as current assets and then adjust the used amounts to an expense account on the income statement, many find it more efficient to skip this adjustment and post the entry straight to the expense account from the initial transaction date. At the end of the period, it is a simple matter to examine the expense account to determine if there are any amounts that have not yet been used. If there are, then those amounts are more properly reflected on the balance sheet. At that point, an adjustment can be made. The adjustment has the effect of properly allocating amounts between the balance sheet and the income statement, just as the more traditional approach does. The nature of most unearned revenues is that they have very short lives. Rather than set them up initially as current liabilities and then adjust the earned amounts to a revenue account on the income statement, many find it more efficient to skip this adjustment and post the entry straight to the revenue account from the initial transaction date. At the end of that period, it is a simple matter to examine the revenue account to determine if there are any amounts that have not yet been earned. If there are, then those amounts are more properly reflected on the balance sheet. At that point, an adjustment can be made, similarly to the treatment of unearned expenses. The adjustment has the effect, again, of properly allocating amounts between the balance sheet and the income statement, just as the more traditional approach as seen with the expenses as well.